So good evening. My name's Tooze, and on behalf of the European Institute, it's my pleasure to welcome you to this evening's conversation about economic policy priorities for Europe in 2020. And it's an absolute pleasure to welcome back to Colombia Marco Buti, who's Director General for Economic and Financial Affairs at the EU Commission. Marco's been in that role for more than 10 years. He began his term right after the start of the global financial crisis. An extraordinary run, extremely rare to maintain a position this senior in the EU bureaucracy for as long as Marco has, a testament to his authority as an economist. And it's been a real privilege to host him repeatedly over recent years. It's become a regular thing and a great pleasure. Before taking up his current job as DG ECOFIN, Marco served in a number of prominent positions in the Directorate General. He was also an economic advisor to President of the European Commission, Romano Prodi, until 2003, and that's the commission that introduced the euro, so a historic commission. Mr. Buti studied economics at the Universities of Florence and Oxford. He's been a visiting professor at the Université Libre de Bruxelles, the University of Florence and the EUI. He's published extensively on fiscal and monetary policy. He's one of the bureaucrats, quote unquote, the faceless bureaucrats of the EU that is in fact a formidable intellectual presence, and you can read his work on Vox EU, the major platform for European conversation about economic policy at regular intervals. We've had the privilege of welcoming Marco for talks at the EUI every October since 2016. This time of year coincides with the IMF annual meetings in DC, and it's a great moment to take stock of the global and European economies. And it's today a particularly important moment for Europe, as a new commission is scheduled to take office on November 1st or on December 1st, since it now appears that the start of the new commission might be delayed. If we can tempt Marco, it would be great to hear his views on this process. This offers an opportunity to reflect on the work achieved by the outgoing Commission in the past 5 years, the Juncker Commission, and also to discuss the priorities for the new Commission in the field of economic policy. Marco is extremely well placed to discuss these priorities, not only because of his current position, but also, as you may have seen in press reports, because he's expected to work very closely with Paolo Gentiloni, the Commissioner designate for Economic and Financial Affairs and former Prime Minister of Italy, who will be in charge of leading economic policy in the new Commission. Joining us in conversation tonight is my friend and colleague Tano Santos, David and Elsie Dodd Professor of Finance at Columbia Business School, who's also the co-director of the legendary Heilbronn Centre for Graham and Dodd Investing, one of the great gurus of value investing.
Oh my.
Tano Santos has published articles in numerous academic journals, as well as several Spanish-language newspapers and magazines. Since 2010, he's also served as a member of the Federal Reserve Bank of New York's Financial Advisory Roundtable, which provides advice to the President of the Federal Reserve Bank of New York in matters related to financial regulation. I would like to thank the School of International and Public Affairs, the International Finance and Economic Policy Concentration, which is co-sponsoring this event with us this evening. And let me also add that this event is made possible thanks to the generous support of the EU's Erasmus Plus programme. The event is on the record and we're recording it on video. I'm going to start with a presentation by Marco, and then we will have a discussion with Tano and Santos and a question and answer session involving you in the audience. But before we get there, please join me in welcoming Marco and Tano to our evening.
And you were recalling a bit my long tenure as Director General of the Commission. Have been saved by crisis, basically. So every time it was time for thinking about new challenges in mobility, we had a new crisis. So in a sense, they couldn't afford to move the Director General in the midst of a crisis. So I mean that's the. I think in the near future, also because the new commissioner is Italian, so I mean you cannot have a commissioner and the director general of the same nationality. Unwritten rule, but I think it's sound rule anyway. So somehow I will have to change job, and I'll come back here in a different capacity, maybe the one Adam alluded to before. And many thanks to Tano for here. So looking forward to the conversation. I think it's a good moment indeed, because we are at the end of the present term of the Juncker Commission, so 2014-2019, 5 years, 5 important years, and it's a moment also in which one could, here as I put in the title, look forward and try to identify from the economic, but maybe a little bit broader perspective, the priorities of Europe. So this is the plan of the talk. So with the legacy of the Juncker Commission, current situation, open issues, what I can envisage, and this is my personal reading, so if you see something that does not square with what you have read officially attributed to me, not to the official Commission position, and also I think it's important to maybe focus at the end on the very short term, because I mean we are facing a number of challenges, not in the medium to long term, but actually in the next weeks. So the new college coming in will have to hit the ground running, and there is I recall an important change in the institutional landscape in Europe, because it's not only the new Commission. You have Christine Lagarde replacing Mario Draghi after an extraordinary spell as president of the ECB. New European Parliament, which has asserted his authority lately. So I think there is a change in the institutional political landscape. In a world economy, and I recall last year we had the conversation was the global governance, which remains very troubled, and where I think as we are going to have in DC during the autumn meetings, meeting of the G7, of the G20, I think there is an opportunity and also a demand for Europe in this very shaky global governance. So, and I'm going to come to that in a moment. Now, basically, with a bit of ex post rationalization, what were the objectives of the Juncker Commission as the Commission came in? I think essentially 3. There was an issue of, you remember 2014, after the double dip recession in Europe, the need to get growing again. So promoting the incipient recovery was one of the objectives. I think the second one, also very much related to the personality of the President of the Commission, so President Juncker, end of austerity. That was the second big objective. And the third one was preserving the integrity of the Europe, which you go back to 2014, 2015, Greek crisis, etc., was far from ensured. So these were, I think, as I said, seeing it today, but also ex ante, I would say, pretty much the objective. So the first one was promoting economic recovery. So these are some of the numbers for the past 5 years. Growth around 2% over, in average, all member states growing again in 2018. Quite substantive performance of the labor market, actually, with almost 13 million jobs during the past 5 years, and a lot of emphasis on kickstarting investment after the slump of the crisis. We are now investment in as a ratio to GDP back to the pre-crisis level. Certainly, the accelerator and the recovery played into that. Also, the Juncker plan, which was greeted with a certain skepticism actually at the beginning, with multipliers which were considered to be excessively generous, actually has produced quite a bit of new investment in 2020 to 500 billion euro, having been supported by the by the Juncker plan. So overall, I think the recovery has taken place. So this was the first objective. The second one was ending austerity. I think austerity very much characterized the initial response to the crisis. I think in retrospect, especially in 2012, 2013, the fiscal policy was very, strongly pro-cyclical at the time, which helped to deepen the recession. We did not have at the time the type of coordination that would have been needed, nor the instruments to respond to the slump in demand. I recall that when the Juncker Commission came in, it was November 2014. It was just a few weeks, and in January 2015 we published a communication on flexibility applied to the fiscal rules, so to the Stability and Growth Pact, which actually was pretty controversial at the time. It remains controversial today in a number, especially Nordic countries and Germany, but where we, without changing the legislation, but changed the way we interpreted the rules to make it less pro-cyclical, to foster reform, to foster investment, and to graduate the adjustment taking into account of the economic cycle. You can see here the little flags on the excessive deficit. So excessive deficit, countries with a deficit above 3%. Back in 2011, it was 24. It was still, I think, about 14 in 2014, and what we have in 2019, basically there is no excessive countries in excessive deficit. So this was, I think, a good result in terms of the overall management of the fiscal rules, not generally accepted in a number of countries, which thought that the Commission enforcement of the Stability and Growth Pact was too lenient. But in fact, if one looks at the results, both in comparative terms, take the deficit and debt in the US and Japan compared to Europe, also the impact of flexibility here. I have indicated we have done a study that having applied the rules in a more, let's say, sensible, flexible way, actually compared to what could have been the counterfactual of a literal implementation of the rules, actually helped to boost GDP by 0.8% over the past 4 years, and helped to roughly create 1.5 million jobs. I'm not going to put my hands on the fire on these numbers, but I think it gives an order of magnitude that implementing the rules in a more sensible way actually helped the real economy as well. So this is the second, and I have to say that this reflected very much the approach of President Juncker, who as president of the Eurogroup beforehand, one of the founding fathers of economic and monetary union, is definitely not an Austerian. So he has attracted quite a lot of criticism, but if one goes back and sees the behavior of fiscal policy over the past few years, I think the Commission approach on this has been vindicated, and I think we would have been in a different and much less pleasant place now had we applied the rules in a much more literal fashion. And the third approach was preserving the integrity of the euro. I think this was far from evident at the time. It took the whatever it takes by Mario Draghi in July at the LSE in July 2012 to stop they rot, but the potential threat of calling into question the integrity of the euro. Integrity of the euro, I mean here some countries exiting. So I'm not saying the dissolution of the euro, but some countries leaving the euro area, and we went actually pretty close to that in 2015 with the Brexit debate. This and again, I think the Commission, the current Commissioner Moscovici, the Vice President Dombrovskis, but the President Juncker himself actually put the foot down in 2015. Also, vis-à-vis positions like those of not the whole Germany, but Minister Schäuble at the time, which was very much in favor of Greece leaving the euro, and that was avoided, and I think it was the right choice at the time. Brexit. That was the difficult debate 2014, 2015. Other countries actually were under assistance program. Ireland, Portugal, Cyprus, with the, Tano knows very well, also Spain as far as the financial and the banking sector is concerned. There was never a question for these countries to leave the Eurozone, but certainly, they were quite a bit, under stress, and the EFSF and the ESM eventually, so the firefighting institution that was created helped to stem the crisis for these countries. What is actually pretty extraordinary, it is not mentioned very much, but during the period in which we had this existential crisis, and maybe I said it already in the past here, but it was, and I have gone through to the whole crisis in the positions as in charge of economic and financial affairs at the Commission. It was a moments in which 2010, 2012, 2015, one could follow on the screen of CNN or BBC the coverage live of the euro area crisis, as when you have a kidnapping or bank robbery with with bank clients held inside, and the prediction at the time was that the euro would not get to the, in certain cases, not to the next morning or to the next week or the next month. During this period here, the eurozone actually enlarged. So what you had Latvia and you have Lithuania, so two of the Baltic countries, which actually joined the eurozone, and two more are in the process of joining. Now there is discussion of joining the ERM2, which is one of the conditions for them joining the eurozone. Two Baltic countries. So this tells you also that joining the eurozone is just not only an economic financial choice. It is clear that for these countries, now we have all the Baltics inside the eurozone. This is very much a choice which has geopolitical ramifications. The pretty stubborn neighbor here of the Baltic countries. So I think just to say, and throughout the period, the support actually for the euro in the citizens has continued to be pretty high, and now I think if you take the latest polls of Eurobarometer, about 75% of the euro area citizens support the euro, which is the highest level ever recorded. So these are the three, let's say, major achievements, I would say. Now, mission accomplished? No. Obviously, we had many things which were left undone, many things which are on which one still has to work. The first one, yes, recovery took hold. I think growth came back after a long period of stagnation and recession, but there is a question mark on whether this growth was sustainable or inclusive, and there is here is what I have dubbed here the 1% economy. And the 1% economy is 1% growth, 1% inflation, and not inclusive in social terms, with most of the wealth creation being appropriated by the top 1%. In European terms, you have another 1%, which is an important constraint, which is the euro area budget that we have. So this is one of the so making growth more sustainable, more inclusive, sustainable from the ecological viewpoint, and going back to macroeconomic stability. So with inflation respecting the price stability definition of the ECB, so around 2%, I think is a challenge that is still in front of us. The second one, end of austerity as of basically 2014. Since then, in average, the fiscal stance in the Eurozone has been between broadly neutral to slightly expansionary. Public debt still high. Fiscal rules remain in spite of what we have done, and I mentioned before this decision back in 2015 remain pretty pro-cyclical. So I think there is still an issue here to tackle. And the euro, yes, integrity has been preserved, but the architecture of the euro remains incomplete. We still have a banking and capital market union in front of us. Work has been done, but we are not finished. We have some form of fiscal union which has to be achieved, and the progress in the past several years has essentially been done through the intergovernmental method. I mean, for those who are not particularly acquainted to this, it implies that instead of member states working within the framework of the institutions with decision making which essentially made via majority voting, there is an intergovernmentalism, so it's the governments and the heads of state and government getting together and with unanimity prevailing. And this is it has its downside in terms of the effectiveness of the decision making. I'll come to that in a second. So still open fields and things to be which will have to be tackled in the future. Now, the negative legacy of the crisis still here, still to be addressed. There is a loss of trust between member states. I think this has been pretty evident, and what has especially within the Eurozone, you had the divide between creditors and debtors, which has become pretty crystallized. So creditors, essentially, Germany and the Nordic countries. Creditors more the southern rim and the periphery. This divide has then led to decision making which essentially relied on the ultima ratio. So loss of trust. So the choice is actually made only when you are back against the wall. So take the example of Greece and also other countries. It was very difficult to make the right choices at the right time. So it was only when we in a sense stirred into the abyss that we found the courage to make important and difficult decisions. Mario Draghi with the 2012 whatever it takes, which actually followed the decision of, to establish banking union in June 2012. But that was the moment in which really, if you look at the spreads as being one of the indicators of stress in the financial markets, you can see that the situation was really reaching limits of danger, and all this implied that we have been pretty inward looking. So in a world which became more fractured, instead of seizing the opportunity to establish a rules-based system, inclusive multilateralism, badly needed in global governance, I think we got very much occupied by our own affairs, so becoming pretty much inward looking. Overcoming these key problems here, I think, is necessary in order to look forward with a certain optimism and do what is and to find, I think, the political wisdom and courage to do what is still needed, and the choices are not easy. So these were the past 5 years. I think good results from certain viewpoints, open issues still remaining. So if one looks to the future, then what are the three, let's say, big first order objectives, also related to what was left over from the previous 5 years? I think moving to inclusive and more sustainable growth, deepening economic and monetary union, so completing the architecture of EMU, and establish a more geopolitical commission and more protagonism of Europe on the international scene. So, key action for inclusive and sustainable growth, what has been announced by the new president of the Commission. I think the European Green Deal. I'm going to look at this through the angle of economic, monetary and financial affairs. There are broader ramifications, but maybe you can come back in the discussion if you so wish. So basically, European Green Deal, here the issue is that how to move to zero carbon emission, and having an overall strategy which imply fiscal, regulatory and investment. InvestEU is a successor of the Juncker investment plan, and an important chunk of InvestEU to promote investment will be green investment. In incorporating the Sustainable Development Goals of the UN into our system of surveillance and coordination, in what we call the European semester, and a new industrial policy which would be more mission-driven and to ensure economic sovereignty through key enabling technology. I think this is also something which is important for the renewal of the industrial base of Europe. So this, in very broad terms, the actions for inclusive and sustainable growth. Key actions for deepening EMU. Here on economic surveillance, we'll need to review how our rules work. We are going to publish by the end of the year, or now with the calendar of the Commission, maybe at the beginning of next year, an ex post review of the surveillance reforms which were implemented, which were adopted back in 2011-2012. So we're going to publish a review on the Stability and Growth Pact, of the so-called macroeconomic imbalances procedures, which broaden the surveillance to macroeconomic imbalances beyond the fiscal, and also how the system of assistance to countries work. And we are going to launch for this an important debate. We are waiting for and looking forward to contributions also from this side of the Atlantic on this, to then draw the conclusion of whether there is scope to change the rules making less procyclical or not. It is far from evident that that will be easy, because the position of the member states are, in a sense, they are pretty entrenched, and there is a bit of a devilish alliance between those who are on the rigorous side and those who are on the more lenient side, not to change the rules. Those who are on the lenient side, they say that in any case the Commission will find the ways to implement flexibility and to find, in various corners, there remote corners, flexibility in implementing the rules. So let's keep them the rules we have. And those who are more on the rigorous side, they say it is not a question with the rules; it's a question with their enforcement. So let's not change the rules, just enforce them in a more rigorous way. They both militate towards not changing the rules, but the rules have become, let's say, so complex that is extremely difficult to read, and they have become complex because of what I said before, because of the lack of trust between between member states and institutions. When you do not trust someone and you are buying a second-hand car, what do you do? You want to write down all the possible contingencies so that you can give back the car if it doesn't work. So this has been the same problem that we have been facing in Europe. The lack of trust has implied the attempt to write the complete contract. As economists, we know we cannot write the complete contract. So, but the attempt has been made. So what you do is actually look at all the vademecum, the implementing rules of the Stability and Growth Pact. They have piled up to several kilos of precisely because we do not trust the Commission in implementing the rules and having the degree of discretion, a judgment. So you try to codify with very complex algorithms, which at the end of the day is make things extremely complex, and with a bit of an inverted pyramid, because not all this, and we had some discussion with Adam also, they rely on certain unobservable variables, like the output gap, potential growth, etc., which are difficult to use, in particular when you have a system of surveillance which imply ultimately, though we have never done it, by financial sanctions. This is actually one of the examples in which certain concepts which as economists wholeheartedly support, like in assessing the state of your budget, the public finances, better rely on cyclically adjusted rather than taking headline figures. So everybody would agree with that. When you start to implement it in a system of surveillance, especially in a multi-country system with a kind of, let's say, lack of trust that I indicated before, then from say no-nonsense and pretty established concept, it becomes a curse, because it's very difficult to do. So it means here, I think we will need to review things. Now, whether we change the norms officially or we proceed by interpretation, the decision will be made after this open debate and consultation that I mentioned before. Now, market discipline and a safe asset. Here, politically, it is absolutely essential to overcome this divide between creditors and debtors. I think we have to, these two groups of countries, they are now in separate buckets, and everything is processed when you look at the potential reforms of EMU through the lenses of a well-established creditor or a well-established a bit sadder debtor. So how do you overcome this divide here. I mean, one thing that we are working on, and there has been quite a lot of discussion. Actually, Tano actually contributed to some of this debate with Marcos Brunnermeier and others, is to consider to improve market discipline and establish a safe asset in Europe. Here, when you talk about safe asset, especially with a German audience, you have immediate skin reactions because they say, well, this is mutualization of debt, and that is the last thing one would want to so transfer union, taking on the German shoulder debt of others. So safe asset here is, and there is a lively debate on this, can be established without actually having this mutualization, or with a degree of let's say risk sharing which is limited. And that if one has that as a proper safe asset, then you can have a better market discipline, because what I'm telling constantly to my interlocutors on the Nordic side is that those who are pleading for the debt restructuring and no bailout clause without considering establishing a safe asset, they are the worst enemies of themselves, because it is clear that envisaging public debt restructuring without having a proper safe asset has such a potentially damaging financial stability implications that is not going to happen in the first place. So actually, the more you insist on that, the more you actually have bailout instead of bail-in. So this is, but the big question is how to build a consensus here. So that is the debate that we need to have in the next months. Completing banking union, capital market union, key for breaking the sovereign bank loop, and here the big question is on the common deposit guarantee. Discussion is taking place on this, but it is not easy, even though I see some I think some movements also in Germany and other countries who are more skeptical about that. So I'm not totally pessimistic that we can achieve this in the course of next year. And for a properly functioning EMU, I think we need some stabilization tool at the euro area level. What has been basically agreed now, Eurogroup last week, is what is called here budget instrument for competitiveness and convergence, is an embryo of a euro area budget, a very small one, but at least it's the first time we have a common instrument for the eurozone and not for the EU as a whole, but definitely not appropriate to ensure stabilization. So what has been put forward by the Ursula von der Leyen, the new designated president of the Commission, is the proposal to have an unemployment reinsurance scheme, which would help to shore up the national systems in case of large shocks. So this is something which is in the plan of the Commission. So key actions in deepening economic and monetary union is the second strand of work, and the third one is the global dimension. Global governance, avoiding what I term here the G1+1. It's not G2, because G2 implies that somehow you have the US and China talking to each other. They seem to be talking, but I'm still waiting for the details of this fantastic trade agreement of last week. The fact that we do not see any detail makes me a bit wary of the relevance of this. It seems to be probably phase one, and then phase two will come. Phase one seems to be more of a mercantilistic one rather than so you buy more of soya beans and other U.S. agricultural products or something of Boeing, rather than tackling at the roots the problems that we have of you know, with China. I think there is a demand for Europe out there that is, I think, there to be grabbed. I have seen it directly. I mean, I've participated in the G20 ministerials and summits since the relaunch of the G20 back in 2008 in Washington. And there is a clear demand for Europe as the guarantor of a multilateral system and a rules-based system. It's not only emerging economies who are, you know, calling for Europe. Not only emerging economies, say smaller emerging economies, but also take India, for instance. No, there is a clear demand, but also advanced economies like take Korea, take Australia. They do not have themselves the critical mass to stand up in a being sandwiched between the 1+1. So they look at Europe as, you know, establishing a rules-based system and defending that. So we have really to raise to our to these demands, and I think there is a clear opportunity here. There is a link between the external agenda and the domestic one, because to play an important role, a key role at the global level, we have to put our house in order and to fix our problems domestically. It doesn't mean here establishing you know, a military superpower in Europe. Now there is the Europe of defense is one of the new frontier. I think will be one commissioner actually dealing with the defense union. But we know, I mean, the Europeans will continue to come from Venus for sure. It's you're not going to start to come to come from Mars, but we have a number of assets that I think we can establish in you know, setting rules which work, which are more equitable at the global level. Take, for instance, just one example: the data protection. I think here we can set the standard for the you know, worldwide. There's something that resonates very well with citizens. Strong influence with partner countries. We have macroeconomic, financial, regulatory dialogues. So as a building block to strengthen a rules-based multilateral approach. Here, geopolitical commission. The fact that the new president was Minister of Defense, I think, has with with an external dimension that is I think important. Is I think implies that I think she will have more of that global reflex than maybe than before, and the international role of the euro as a key development for establishing our economic sovereignty. And here again, there is no shortcut. We need a deeper EMU. If we want to establish a stronger role of the euro internationally, is not by gadgets or other shortcuts. So a key message here is that I would like to pass is that there is an intimate link between the domestic agenda and the global one. So these are the three let's say medium-term objectives. Then come back to the very short term. So I need a reassessment of the policy mix in the present juncture. The economy is slowing down globally, slowing down in Europe, and monetary policy has basically done what it could do. I'm not saying that there is no other something else that monetary policy can still do, but certainly the constraints are coming to the fore more evidently. So fiscal policy has to step in, and here Mario Draghi has been very clear. And actually, in the controversial meeting of the Governing Council, which has had a number of I would say, pretty unwelcome declarations and not very constructive debate afterwards. There is one thing that Mario Draghi indicated on which there was a unanimous view of the governors was the need to have a more active fiscal policy to support monetary policy. So, and here is, I think, is my final slide. What is the adequate policy mix which would cater for the short term but be consistent also with the longer term priorities which I have outlined before. So on the monetary policy, patient, persistence and prudent, this is the courtesy of Mario Draghi, the Sintra speech back I think June. So that was monetary policy should do. Fiscal policy, this is courtesy of Larry Summers. Larry Summers secular stagnation, because in order to make consistent with the secular stagnation, actually I have added here the question mark after temporary. So it would be timely, targeted. So do the right things, take care of the quality of public finances, and temporary. And here, if you embrace the secular stagnation view, I think it can be more continuous than temporary. Actually, if you apply, this is in general terms, if you want to add another T which is specific for Europe, then I would say tailor-made, because it is clear that countries have different fiscal space, different level of debt, and they cannot all use fiscal policy the same way. So the recommendation here is especially for those with fiscal space to use it for essentially for investment, and the other countries with less fiscal space to maintain a more prudent approach. So this is timely, targeted, temporary, and tailor-made. And then on structural reforms, you have the F, courtesy of myself. So feasible. So don't try to do things which are for the very, very long term, but difficult to implement. I think forward-looking, yes, to be consistent with the objectives in Green New Deal, sustainable and social Europe that I indicated before, and fair, precisely to make the structural reforms not being identified with blood and tears, but also taking care of, let's say, an equitable distribution of resources. So, questions here, some have already implicitly answered. Can monetary policy achieve internal and external equilibrium alone? I think the answer is no. Is it time to shift from a broadly neutral to a more expansionary fiscal stance? I would say yes, respecting the T's that we have here. And then on the structural reforms, can we have some more positive incentives to promote that? And there are some implementation of the EU budget which would try to use some proper incentives, and implementation also of the fiscal rules which will provide incentive for structural reforms. So I think I finished here. If you read counterclockwise, you start from fiscal policy, you have TFP, which is, I think, total factor productivity. That's precisely what Europe needs now. Thank you.
Thank you.
The way I think about, let me start with a small anecdote that during the financial crisis, I was spending some time, and this will go to the issue of me being the director of the Hellman Center for Graham and Dodd Investing. I was spending some time in a hedge fund, and what was interesting about the hedge fund and what I learned from staying in the hedge fund is that I was trying to convince everyone of what wonderful investment opportunities there were in Europe in terms of buying particular companies that were trading at very deep discounts. And what was absolutely fascinating was to see American investors essentially with so little knowledge of the European Union, of the commitment the Europeans have to their own institutions, to how much we were willing to put in order to save our monetary union. And this is not to be underestimated, and this is one of the great lessons of this crisis, is that we went through a massive crisis. And what is remarkable to me is that, yes, There were very critical moments, there's not to be denied, but a lot was done from an institution that looked very slow and very unable to take decisions. In fact, remarkable institutional reforms were undertaken at the European level, and the commitment of the Europeans to their own institutions, in particular to the euro, remain in place. And I think there's a question there as to why was this the case. And I think this is something that I'm going to take a comment by Marco, who was mentioning this thing about that the euro is more popular than ever, and I want to come back to that because I want to put my finger on exactly the sources of the popularity, because as long as those reasons remain in place, the euro will remain popular, and I think that will be a useful way of thinking about our institutions in Europe. I think about Europe in two forms. What will it take for the European Union, for Europe to grow? What will drive economic growth in the years to come? And I will make some comments about that. And what will it take to make the Eurozone stable, which is, I think, the second leg of your emphasis. And I'm going to keep this slide here because I think it's perfect in terms of organizing our thoughts about this. My sense is that there's been an excessive emphasis on fiscal rules in the European Union in general. This springs from an old idea in economics that monetary and fiscal policies are joined at the hip, and that if you fix monetary policy, then essentially that has implications for fiscal policy. This is true. The very old paper in economics called Unpleasant Monetary Arithmetics by Sargent and Wallace, who was the first that actually made that point in the academic community. But if you read the Werner report, that comment is already there, that the problems of advancing to a monetary union had to do with issues related to fiscal policy and what it meant for the fiscal policies of member nations in a potential monetary union. Now, one of the things that it is important to understand and think about the last crisis is what limited role fiscal transfers had, even if we had them at the time. The argument about a fiscal union is that countries that do well can provide some insurance to countries that do poorly. But this is not what went on in the Eurozone crisis. We were all doing poorly. There were some that were doing even worse than others. Okay, but that basically would mean that the countries that are doing poorly would have to make transfers to countries that are doing very poorly. I'm not a political scientist, but the political economy of that strikes me as very difficult. So this is purely from a temporary point of view. I'm going to basically argue that the reasons why we don't have a fiscal union and we're not advancing there have nothing to do with that, though, even though the welfare benefits associated from that during the Eurozone crisis, I think, in my opinion, have been greatly exaggerated. Of course, fiscal policy should never be procyclical. It should be countercyclical. That goes without saying. Okay, but again, the welfare gains associated with this risk sharing, I think it was much more limited than. And this is something about the short term. You're absolutely right. And whether you think we should have an expansionary fiscal policy, as far as the eye can see, because there's a lack of demand that is secular, as Larry Summers would have it. I have no idea. I think this is something that we're all struggling to understand what is going on in the world today in terms of low rates of growth. I want to talk, though, about this for a moment, because we talk very little about this, and I think this is the key to many things in the European Union and in the Eurozone in particular. And I think sometimes it's not properly appreciated how important structural reforms are in Europe beyond the direct benefits on getting sustainable growth. I'm going to argue shortly that they are key to deepen, in particular, our monetary union. So let me, I have a couple of pet examples. Poor Adam has heard me on several occasions mention the same thing, so if I sound like a broken record to you, Adam, I apologize. But, let me pick up a particular example, just to make it very, very concrete. The sources of growth for Europe in the next few years are not going to come from any type of innovation. It's going to take essentially from having European companies moving to the efficiency frontier. So what happens in Europe, unlike in the United States, is that sadly we have markets that remain very much segmented, in particular in the service sector. So that's why we have a lot of inefficiencies associated with the small size of firms, say in countries such as Marco and my own, Italy and Spain. And we need to understand why is it that particular companies are not reaching their full potential and growing. And this has to do with the massive protections of local markets across Europe, in particular in the service sector. And one thing that I would like to see is a decisive effort by the Commission to really get going with the service directive and implement a single market when it comes to services. I cannot emphasize how important I think this is for the future of growth in Europe. So that's one place where we can make some progress. And I will come back to your comments about the budget for competitiveness and convergence, which I think holds the key for many things. The problem, in my opinion, and I would of course be anxious to hear what, is that to me, what worries me is Germany also in the future, contrary to popular belief, I think Germany faces some challenges. It's a country that emphasizes a particular sector at the expense of another, which is manufacturing, and that introduces, as we all understand, permanent deflationary forces in Europe, which make for difficult adjustments in the EU and in the Eurozone in particular. This is something that it's a deep issue related deeply to the establishment and the way the German policy establishment sees the role of Germany, but I think this is at the heart of many things in our economic comings and goings. So this is what concerns kind of the long run of the EU growth. I think there's some room for structural reforms. I'm going to argue next that these structural reforms are in fact key to deepen the monetary union. The way to think about the problems that we're having in the monetary union, in my opinion, are not related to an issue of trust. They're related to an issue of agency. So the way to think about the Eurozone is that we have a bunch, in the parlance of economists, there's a principle, an agent, the principle wants to give incentives to an agent. We have a bunch of agents and we have no principle. Okay, we have people with veto powers, so all the agents that can veto a particular. But why? What is the issue? Why don't we want to go and build a deeper monetary union that can contemplate potential some fiscal transfers? So let me give you two examples of why this is a problem in our monetary union. So think about unemployment insurance. You mentioned unemployment insurance. So if you're going to have a system where a component of the insurance is done at the federal level, well, like any insurance company, you would want to know that your members in that insurance company abide to certain rules, because if not, the transfers will always go in the same direction. So you can only have a federally funded unemployment insurance scheme in Europe if somehow the Spaniards reform the labor market so that it's less cyclical than it is. Because you know that in the next crisis, given also, by the way, that the business cycles in the Eurozone have become more synchronized across member nations, that the transfers are going to go exactly in one direction. That's not an insurance company. In an insurance company, transfers flow in both directions. That's why you don't want to go into an insurance company with people who are already sick, because you know that if you're healthy, you're going to be paying for them. That's why these insurance pools unravel all the time. That's why these Obamacare exchanges are unraveling. It's not very deep. We've understood these things in economics for a long time. Let me give you a second example to illustrate this. So think about a federally funded deposit insurance scheme in Europe. Well, now we have the banks have deposits. The banks do something on the asset side of the balance sheet that is quite important for the economic well-being of nations, which is granting mortgages to households. There are countries for which this is actually quite important, such as Spain. Well, if the Spaniards get into trouble, the Spanish Congress in its sovereignty can actually change mortgage laws, perhaps implement a mortgage moratoria, and transfer the losses in the bank's balance sheets that would translate into deposit haircuts directly to a federal insurance deposit scheme at the European level. But that tells you also the key of what is needed to make the Eurozone stable. It involves tying in federal institutions to particular structural reforms at the member nation level. Now, I'm not a political scientist. I don't know to what extent this is feasible. But that seems to me the only way we're going to get this deepening is by allowing structural reforms that are growth enhancing to be linked to particular federal institutions. I think right now this cannot happen in the Eurozone because there's no serious effort whatsoever to kind of clean us up in a way to enter into this insurance arrangement. This played out quite vividly, by the way, in the crisis itself. The problem of actually that we had during the Eurozone crisis is that you knew already the banks in Spain or in Greece had phenomenal legacy problems. Why would you want to enter into a banking union with a banking sector that is already bust? This is not going to work. So first you have to clean it up, and then you can actually implement the banking union. This is exactly what we did in Europe, with one exception, which I think is Italy, but I don't know about this. I have some thoughts about this, but we can discuss it another occasion. But essentially what happened is that the Spaniards have Greece is small peanuts. Just think about Spain. The size of the balance sheets of the Spanish banks at the peak of the cycle was about $3 trillion. There were 1.8 trillion euros of Spanish liabilities flying around, mostly held by French and German banks. So that's a big problem. It's a big legacy problem. So what we're going to do? Well, we're going to finance the Kingdom of Spain, the sovereign, but we're not going to basically allow for losses in the liability side of the Spanish banks and distribute the losses with the European taxpayers. Because that's going to be, that should have been what happened. It didn't happen. But we're going to fix it by cleaning up these balance sheets, okay? And then we'll do the banking resolution and recovery directive, okay? So these are the impediments towards, these agency problems are the impediments towards a deepening of the Eurozone. Let me just leave you with one thought, and with this I'll conclude, Adam. The reason why the euro has remained popular is because there are powerful constituencies in Europe for price stability. That's essentially what the welfare state gives you. You have a bunch of people on pensions, on unemployment insurance, and other benefits. These people have a very strong interest in price stability. This is not lost on Spaniards, on Portuguese, on Italians, or on Greek countries that have relatively large welfare states. That's why the monetary union has remained stable, is because there are powerful constituencies in the member nations for price stability. Once that is removed, either because you incentivize or introduce incentives in the welfare state, one of the things that would be gone would be precisely the constituency for price stability and then for a monetary union. Thanks so much.
Thank you, Tano.
Hi, I'm Joy Fairbanks. I'm an alumna of the Columbia Business School, and I'm involved in a variety of things, working with entrepreneurs. The question I have at the moment is, how, into your thinking, are you incorporating the possibility of the Libra, cryptocurrency, or something similar? Because even if I know we've seen a lot of pullout of Libra, but eventually something similar could happen. So, is this something that's being addressed with regulation and, all the different ways that you're thinking about it? I'd be very interested in hearing.
Excellent. Do you want to come back on that?
We take one by one.
Yeah, why not?
Okay. No, I mean on this, I think on the Libra. Actually, there's going to be discussion in Washington and at the G7 and G20 in the next couple of days. There are strong concerns about Libra. I think there is one element which I think has been incorporated in the reflections after the initial very defensive view on this, and to a certain extent the Libra response to objective demand. If one looks at the smoothness cost of transfrontier payments and things. So I think what has been a good result of this debate here will be that I think there will be reforms in order to make cross-country payments much more much smoother, and I think reducing the cost, reducing the positions of rent that you have there. I think this is something that is going to happen for sure. Second thing is that it has put on the table very prominently the issue of public digital currency. So I think the central banks will are already working and will work more in the future on these matters here. Clearly, the regulatory the concerns that the Libra has triggered are real. And for a number of countries, I think not so much in Europe or for large countries, but also you take smaller economies, emerging economies, the dislocation risks related to Libra with such a huge potential audience is such that I think we'll have to be very prudent on this. I think there is the possibility of certainly, let's say, use it in a positive way in terms of financial innovation. But I mean, the concerns for the moment are, pretty, the stakes are pretty high, and I do not see this being, eased into coming to fruition anytime soon.
Thank you.
Yes, hi, Dylan Vanis. I'm a PhD student with the History Department. I do modern Germany, I've lived in Germany the last couple of years. So I've got a couple of questions. One is sort of the elephant in the room, and this is, the sort of the rise of the anti-EU far right. And what I found interesting is, I'm biased in my examples from experience in Germany, but the Alternative for Germany party has pivoted over the last few years from the unsuccessful get rid of the euro campaign to the much more successful anti-immigrant campaign, and now that this is sort of going away as a very urgent issue, they've made a new pivot to being sort of the anti-green party. In what ways is this sort of them, maybe ironically, an attempt to embed themselves into the EU, and sort of anticipating too the inevitability of this sort of push for a Green Deal, a European Green Deal? And the second question is, you, Professor Santos, how is it that we can, if I understood your comments on the necessary preconditions for structural reform, how is it that structural reforms at the individual member state levels, how is it that reforms could be put into place in a way that's sort of functionally not going to be in austerity measures, for lack of a better term, right? So if they have reforms to their unemployment systems, how is it that the public's not going to take these as being austerity measures, which then plays more deeply into this sort of creditor-debtor divide?
Thank you. One each.
Okay.
Feel free to
I'll start with the latter one. I mean, I think you're absolutely right about the following, which is, I think one thing that was a terrible mistake during the crisis was to even mention the link between assistance in some form and structural reforms. I think this was a terrible mistake. The welfare state is radioactive in all countries for a reason. It is radioactive here, it is radioactive in Europe, it's radioactive in because it's kind of like the nexus of contracts where all these big political decisions are taken, and it's very difficult for an external force such as the EU to come and tell someone how you're going to mess up with those contracts that are the reflection and the historical legacy of a bunch of bargaining games that were played in the past between classes and so on and so forth. I'm not proposing that, and I think actually the last thing I would do in the next crunch time is again to bring this up. This is not the time to do it, precisely. I think it goes back to something that Marco said, that you can have it in a more positive way, which is, hey, we can create an insurance arrangement in this area or in that area, but if you want to participate, these are the things you need to do. I'm not telling you to participate, but it would be nice for you to participate. Is there a way of actually realizing some of the risk-sharing gains by giving the incentive of the insurance that you will get provided you actually. So that is kind of the
So
incentive.
you get to join some kind of European-wide unemployment
Yeah.
insurance scheme if and only
if you do certain
you do things to get your youth unemployment down below
exactly,
20%.
and the cyclicality of employment, something about the structure of time versus permanent contracts, whether you have a continuous schedule for firing benefits, those type of things. There are some issues that are also tricky because they involve taking away from Parliament some of their power. So the example of the mortgages is one that I remember telling people around, that if I were a country and all of a sudden I have a problem in the banking system and I have federal deposit insurance, the first thing I do is give my voters a mortgage moratorium. That's going to be great, and you transfer partially the costs abroad. So it means for countries to give up the possibility of legislating how the losses in the banking sector are going to be apportioned between, citizens of the member nation and Eurozone taxpayers. So those type of things. But I'm not a political scientist. I don't know to what extent there's the mood for these things, and whether even our political class understands these, and whether Brussels is up to these type of things.
Okay, let me continue on this. Then I come to your first question. I agree that more courage on structural reforms, and here one would have to actually articulate this in a more granular way, because structural reforms is a bit of a general, generic terms. Usually they are identify blood and tears. I think some of my F's there were precisely in order to dispel a bit that kind of perception. One thing which is a bit of a caveat on what Tano just said is that we should make sure that we do not put the bar excessively high on this, because if we tell countries, look, you have to come to a full, a liberalization of the labor markets, the labor market institutions, which are pretty similar, etc. I am afraid that the differences right now, they are so entrenched that we, if you put that as a condition, then I think you never get there. So I think one has to be reasonable in what can be done. And I think one way to make a system of unemployment insurance at the European level function is to use a certain, let's say, definition of the trigger for assistance, which is, let's say, robust to policy mistakes. So, for instance, what one would not want is that if one makes policy mistakes, then you have a problem that is self-generated, and the others will have to contribute to solve the problem that yourself have created. This clearly cannot work.
Yeah, of course.
But what one can do is
somebody decides unilaterally to triple their minimum wage,
Yeah, exactly.
Yeah, so
causing youth unemployment, and
from the inflation viewpoint, I
Exactly.
think maybe would help that. But
Because
okay,
they have
now-
this agency issue.
yeah,
which is at the heart of
so I
it.
think one has to establish the conditions, at the same time to set also some screening device and the trigger. For instance, if you look at the for the unemployment level, both the delta and the average over time, I think you can in a sense stem a bit the kind of risks that you have, because I mean the average over time, I think, will be different depending on the labor market institutions that you have.
how about the populism question?
No, obviously, on the populist questions, I think there is one thing. If you look at the latest European elections, so last May, there has not been, there has been an increase in the share of populist vote, most from the right than on the left. But actually, compared to the nightmare scenarios that we had before, it was, it fell short quite a bit. And the if you look again at the European election, there were two elements which I think were quite important politically. And here, I mean, I'm outside my comfort zone, but okay, since we have an open discussion, we can look at this. I think basically those who were the parties who had more success were those who brought an element of novelty. Was either on the right-hand side, the populist, more sovereignist type, or essentially the green in a number of countries, Germany, but also Northern Europe, Belgium, France also to a certain extent. So there is, let's say, the need of shaking up the establishment that was very much conveyed, either in a more positive, constructive way, at least from my viewpoint, or in a most disruptive way. On the far right, I think there is one thing in common, and is that I think and AfD, I think they have, in a sense, they had a genetic mutation or repeated genetic mutation over time, because they are not talking about leaving the euro anymore, really. And I think why so? The answer is Macron-Le Pen. Between the first and the second round of the elections, where it was clear that Le Pen wavered on the question of leaving the euro, and she, I think, lost badly support on that. So I think even in countries like mine, where you have the Lega, very Eurosceptical, I mean, they are very, very careful in not proposing to leave the euro.
Yes, question here.
So, Peter Linseth, I'm a professor of law at the University of Connecticut. I also got my PhD in history here many years ago. And it really continues, in some sense, the first part of the discussion in response to the last question. So I was struck, as Marco was presenting, what he was describing was an entity that has certain capabilities, and it's essentially a technocratic entity that acts as a pre-commitment institution on behalf of a multiplicity of principles, that is the member states, and they pre-commit to certain policy goals, and that the entire structure is built around those pre-commitments, hence the emphasis on conditionality, but all the resources have to be mobilized nationally. And then your access to those resources, again, is entirely a consequence of whether or not you meet those conditions. So those are the incentives that are created for the member states, but it also creates inherent limitations on what the supranational agent can in fact do. And that Tano was actually re-emphasizing these limitations in some sense, because certain kinds of questions require a robust democratic and constitutional legitimacy that is not merely technocratic, in order to mobilize the resources necessary in order to undertake, say, a robust reform of the services market throughout Europe in order to create a genuine market beyond individual member states. You're going to have to do significant payoffs at the national level, and that's going to necessarily require transfers. And that's the bridge too far, it seems to me. Tano kept on referring to it in political economy terms, but you can also understand it in principal agent terms about the nature of the institution that was created, and it's always acted that way. And in some sense, Europe is now at the absolute edge of what it can accomplish as a pre-commitment institution. And the Rubicon that it's facing is the need to create some kind of genuine democratic and constitutional legitimacy that is really denationalized, so that policies can be made, and most importantly, resources can be mobilized in ways that are not entirely dependent on national politics.
Before you respond to that, Marco, there's another question back there. We'll have that as the last one. Yes, you.
Yeah, sure. Hi, I'm Ruben. I'm a student at the European Institute, and I'm doing work on the Iran nuclear deal. And I was just wondering, with regards to secondary sanctions and the way in which the European Union was unable, to kind of execute its policy prerogatives vis-a-vis, the U.S. in this regard. To what degree can the deepening of the financial markets, and kind of the setting up of alternative payment systems, and the deepening of the completion of the capital market, and as you, Mark, I think referred to, increasing the number of safe assets in the Eurozone, to what degree can that contribute to the European Union in the future being more resilient to U.S. pressure in this regard?
Great questions. very political, but fascinating.
Okay, then I have a couple of comments on Tano's.
We'll give you the final word, Marco.
Okay, I take this first.
Yeah,
and then,
exactly.
Okay. No, I mean no, I think great questions and great hints. I think the issue of democratic legitimacy is an important one. And actually, when we talk about completion of economic and monetary union, which is one of the euro being at the heart of the, so it's we have shared a lot of sovereignty, and clearly gone to the core of what nation state is by pulling together monetary sovereignty, and what we have done during the crisis is to create institutions which actually, because it was the only way to proceed. The question was the survival of the euro was so high on the political agenda that became chef hake. So the heads of state and government, we took charge of that. And linked to what I indicated before, this crystallization of creditors and debtors actually implied that they proceeded by an intergovernmental way, and one of the consequences of the intergovernmental way of acting is not only that it requires unanimity, it is less effective than the way we operate through what we call the community method, but ultimately the legitimacy is provided by the national parliaments, not by European instances like the European Parliament. So take the ESM, actually, so European Stability Mechanism, those who actually mobilize the resources at the national level, at the national parliaments. So I think we will need to go beyond what we have now. The reforms are obviously very difficult. There has been a number of proposals of the Commission to make the functioning of the Eurogroup more transparent, more legitimate. But it is an uphill struggle. But I fully agree that we have gone so far in terms of sharing sovereignty that we cannot go the extra step by stealth. So I think the issue here has to be in traditional Europe, historically, the economic integration has always preceded the political one. I think now it is the moment in which one cannot simply go through the extra step economically without calling into question. And if you take again banking union, to a certain extent, banking union, fully fledged banking union with a common deposit guarantee, is as much, if not more, involved in terms of sharing sovereignty than the currency itself. So I think we are really at and that's why it is very, very difficult, because you touch the open nerves of national sovereignty, which is, I think, is difficult. So this now on Iran, I think when I mentioned here in my slides the international role of the euro, actually the going back, putting this back on the agenda was also linked to the U.S. sanctions. So it is in a way a response to the secondary sanctions, and to make ourselves, let's say, more resilient compared to those
the unforgettable,
the
unforgettable bodybuilder image.
But again, I stress we have a work program on the international role of the euro. We are discussing with a number of sectors, with a number of countries, but the essential issue here is that we have to complete the architecture domestically in order to make sure that to give a chance to the international role of the euro, which is important also from the point of view of the global implications and the sanctions that you mentioned.
Thank you very much. This has been absolutely fascinating.
Okay,
really
let me say what.
Do you want to?
No, I want to say a couple of things
it's
not because I disagree, but because I had something interesting to say.
Everything has been very interesting.
Okay, now one thing is that okay, you mentioned the Sergeant Wallace, and, the unpleasant arithmetic, monetary arithmetic on 1981,
81.
and there what you had the fiscal dominance versus monetary dominance. So the rules, the Maastricht rules in the first place, were an attempt to respond to the issue put forward by Sargent and Wallace, namely how to avoid fiscal dominance. So all the rules, the deficit, the debt, was to make sure that there is monetary dominance in the monetary union. Fast forward to today, and what we risk to have is Sargent and Wallace on its head, because once you have given the ECB the task of ensuring price stability, defined as 2%, and if you do not have a sufficient support of fiscal policy, you actually ensure fiscal dominance via excessive prudence, not excessive profligacy. So we have moved into a world of negative interest rate.
Because everyone always assumed the problem was irresponsible democratic politicians who would run gigantic deficits, and their problem was to defend against, and we have the opposite now.
Yeah. Exactly. So now the second point, and I end here because we talk about the reforms during the crisis. Basically, the reform during the crisis, fundamentally, we have because of necessity, violated Raoul's principle of reforming under the veil of ignorance. So during the crisis, what happened is that we made reforms knowing ex ante who benefited, who suffered from them. So what we need to do is actually recreate the veil of ignorance. So and that is essential in order to overcome this crystallization between creditors and debtors. What is the way of doing that? I think it's a political awareness that the creditors of yesterday are not necessarily the creditors of tomorrow.
So are you saying that bad news for the German car industry could be very good news
for
the
Eurozone? I'm not going to say...
I've said that before. I'm just wondering whether you'll say that.
You take responsibility for that, but de facto, I mean, if we enter, and we are going to see, we have the 13th of November rendezvous for the tariffs, decision of tariffs on automotive things, with the vulnerabilities of the German economy and the reliance on the car sector in this in this very troubled global governance. It may be that instead of Greece, Portugal, Spain, or Ireland, the next crisis, maybe the request of solidarity will come from from those quarters instead of from the southern thing. So I think recreate the veil of ignorance is very important, and I think having a more dynamic view of where the challenges come, I think will help to break this crystallization. And I had one thing that I wanted to read to you, and I finish with this because I think it's very good. And it is the definition of solidarity by Habermas. So I read it here because I selected before coming here. So it's a few lines. So how does he dub solidarity? Solidarity is a term that describes the mutually trusting relationship between two actors who have become part of a joint political project of their own free will. Solidarity is not charity, and it certainly isn't a form of conditioning for the advantage of one of the actors. Those who engage in solidarity are willing to accept short-term disadvantages in the service of their long-term self-interest and in the knowledge that the other will behave the same way in a similar situation. Reciprocal trust, I go back to trust, that in our case, trust across national borders is just as important as a variable as long-term self-interest. Trust bridges the time span until a service in return is due, though it is unsure when or if it will ever come due. So I think this is it's a good way of looking at the recreating trust and interpreting solidarity not in one way as a one-way street.
Thank you very much.
Yeah.
Thank you.